Hello, everyone. Thanks so much for joining us. We'll give people a minute or two to get in here. All right, looks like it's slowing down, so we can go ahead and get started. I'll do my housekeeping stuff and then turn it over to Dr. Kuehl. So first off, welcome everybody. Thank you so much for joining us today for the Q1 Economic Update webinar with economist Dr. Kuehl. So we'll be talking about all the great things that are happening economically right now, and there's plenty. So first, please be aware that this session is being recorded and the recording will be shared after the session. You're welcome to share that with anybody or rewatch it. And if you have any questions, please post them in the chat. You're welcome to post them during his presentation and we'll have time for question and answer at the end. So I'm happy to introduce Dr. Kuehl. He's the Managing Director of Armada Corporate Intelligence. He provides forecasts and strategic guidance for a wide variety of corporate clients around the world. He's the economist for several national and international organizations. Prior to starting Armada in 1999, he was a professor of economics and finance for 15 years, and he holds advanced degrees in economics, Soviet studies, and East Asian studies. He's the co-author of the Flagship and the Strategic Intelligence System, both publications of Armada. We're very happy to have Dr. Kuehl here with us today, and I will go ahead and turn it over to him at this point.
Very good. So I will share my exciting as gosh, you know that there's nothing that people like more than looking at graphs from an economist. Now you just have to get to the beginning. So can you tell I just got through doing one of these a minute ago? So, all right. Ta-da! So this is what I look like when I'm trying to explain economics. There's this frantic look on my face because things change. You have all by this time been made familiar with my favorite definition of an economist, which is somebody who explains tomorrow why the predictions they made yesterday did not come true today. We are eternally grateful that meteorologists exist because they make us look good. And lately, of course, that has been an even bigger issue. I'm not going to belabor the bank issue to death, but it's significant and it's something that has been affecting every industry, including yours. So we'll talk a bit about that and then try to get more into brass tacks, things that affecting woodworking and finishing and the architectural world and the construction world and all the different things that impact your sector. So to begin with, the elephant in the room, what in the heck was going on with the banks? And I don't want to turn into a media basher, but I end up becoming a media basher. We're just now beginning to get the kind of information that we probably should have gotten at the very beginning. When all of this broke, there was a certain amount of frantic and overexcited coverage coming from the media, and it was coming not only from the regular media but even the financial sector, and there was this gloom and doom. Oh my goodness, we're heading back to what we went through in 2007 and 2008. All the banks are going to collapse and the government's going to have to bail everybody out and the whole world's going to come to an end and we're going to go into a recession. You heard all the same things I heard. But now we're starting to get kind of a dose of reality. For example, Silicon Valley Bank. Silicon Valley Bank has been under investigation by the Fed for nearly 6 years. They have been criticized by the Fed for 6 years for policies that were setting them up to fail. The Fed does not have the regulatory control over banks the size of Silicon Valley to make them do anything. All they can do is look at them and say, you are doing really stupid things, and it's going to pay to change these. You're on a bad path. I mean, to begin with, Silicon Valley Bank is a very high risk operation because their specialty is financing high-tech startups, which have one of the highest failure rates of any business in the country. And we know why. I mean, most of these high-tech startups are some guy that came up with some brilliant app or something that he wants Oracle or Microsoft or Amazon to buy. And if they don't buy it, then this poor guy has to actually try to run a business, which he doesn't know anything about. And the business fails. And SVP is holding that loan. SVB also was heavily involved with bonds, and this is not unusual. Most banks use long-term bonds as an asset base, but as we'll talk about in a minute, there's a factor when you're doing that called duration risk. And I don't want to go into gory detail, but Tom Honig was the head of the Federal Reserve in Kansas City. So he was my Fed chair locally. And if you go back to 2007, 2008, when the decision was made to lower interest rates to near zero, it was an 11-1 vote by the Open Market Committee. The one dissenter was Tom Honig from Kansas City. And Honig said then, and has continued to say since, lowering rates that far is dangerous. It creates a loose money environment that is going to be hard to get out of later. It distorts the market, and it also makes it almost impossible for people to save in traditional ways. All of this is going to come back to bite you. It's going to come back to bite you because of duration risk, and it's also going to come back to bite you because of what it forces banks to do. Banks make money two ways. One is by benefiting from the deposits that are made at the bank. They basically are going to make money from the interest rate that is being charged, unless the interest rate is incredibly low, in which case people don't use banks to save. I mean, when's the last time any of you bought a CD with rates that low? So suddenly banks were not able to make money in that traditional way. So all they had left was the riskier behavior of making loans and getting into other investments, which we'll talk about in a minute. So even from the very beginning, Honig was saying, look, this is not going to end well, because when the loose money policy begins to erode, which it eventually will, the central banks, Fed included, are going to have to start dealing with inflation. And that means that the value of those long-term bonds change. SVP was not ready. The public bank was not ready, and Signature Bank was not ready. Most of the other banks, virtually all of the other banks, were ready. And they knew how to deal with duration risk. And they came out of this, they felt the pain. I mean, their long-term bond investments were not any better off than those by the other banks, but they had a broader portfolio. But what irritated me more about some of the coverage was some of the inaccuracy that just fed the hysteria. For the last 3 weeks, I guess, and I'm going to be doing two more of these talks in the coming days, I've been speaking to a group which is affiliated with the Federal Home Loan Banks, FHLB. And I'm not sure how familiar you are with what the FHLB does, but they're basically a government institution that backstops smaller banks that are trying to provide loans for people to buy homes who would otherwise not qualify. So many of them are rural banks, and many of them want to loan to people in their neighborhoods. because that's community development and they want to get people into homes, but many of the people are not maybe in a position to provide the down payment, whatever the problem. So these banks turn to the FHLB for backing to say, look, if you help us, we can make these loans. They also turn to the FHLB to help them with liquidity. So the report came out in some local discussion that banks who were members of the FHLB had been turned away by the FHLB and were not able to get support for their liquidity needs. That was 100% inaccurate. Not one bank in the entire FHLB system was turned down, not one. The backstop that they needed was there, the liquidity was there, and it didn't even strain FHLB to do this. They just shifted their priorities around for a bit and provided the liquidity. But that report got around the country, and all of a sudden people were panicking. It was like, oh my God, my bank is going to be in trouble because the FHLB is not. Untrue, completely untrue. And that kind of reporting just kind of made things even more awkward than they should have been. So enough of my ranting. What transpired so far? Raising interest rates ultimately triggered the crisis because you knew it was going to happen. You knew that at some point interest rates had to come up, and they did. And banks that were too dependent on bonds were going to suffer. Now that the dust is clearing a little bit, SVB found a buyer. First Citizens Bank out of North Carolina has bought them, and Signature Bank is in the process of being purchased as well. So you looked overseas, Credit Suisse, which was a bank that was badly run in Switzerland, was under investigation in Switzerland, has been purchased by UBS. So little by little, the big banks are stepping in, and First Citizens isn't one of the big major money center banks. It's the 16th largest bank in the US, now a little bigger. We've got a series of questions that will be coming up down the road. For example, if uninsured depositors are being treated the same as insured depositors, why do we have this system in place anyway? So there's going to be a lot of questions about deposit insurance. Should the numbers be increased? What should we do with it? That's a conversation for later. The big issue economically was whether the Fed was going to start to rethink the whole interest rate strategy. And it was pretty obvious that in the short term, no, they went ahead and raised rates anyway, not by a lot, but it was what they had anticipated raising rates by. Down the road, I think there's going to be a little bit more discussion about what is the ideal interest rate. We'll talk about that in just a moment. But many institutions still pushing, saying, look, the big issue is still inflation. Don't want to take your foot off the pedal right now, even though this is causing problems with some of the banks. It is not as big a problem as not paying attention to inflation. Last point to make, and this is probably the more important of them, you're dealing with dual mandates, both for the central bank and for banks in general. And often people don't quite understand how that plays out. The Fed is required to do two things. It is supposed to control inflation. It is also supposed to grow the economy, promote economic growth and jobs. Doing those things are diametrically opposed. If you want to control inflation, you raise interest rates. If you want to grow the economy, you lower interest rates. So how exactly is the Fed supposed to go up and down at the same time, left and right at the same time? How do you encourage the economy and control it at the same time? You can't. You have to make a decision. For 10 years, the idea was, let's grow the economy. We were coming out of a bad recession in 2007, 2008. The whole focus was we need to get these jobs back. We need to get the economy growing, lower rates. Now the issue is inflation. So now it's like, well, nope, we need to raise rates because the bigger threat is inflation. The Fed can't do both at the same time. Dual mandate for banks too. On the one hand, they're supposed to be safe places for the public to keep its money, but they're also making their money by taking risks. Banks are in the risk business. If they didn't want to run any risks, they wouldn't be anything other than a place to put your money like you're putting it under a mattress. But if you expect to get interest on your savings account, if you expect the bank to, they have to take risks. Every loan they make is a risk. They're in the business of mitigating that risk. They have to do these things in order to grow. But that's the balance. Some banks are much more conservative, others are much more aggressive and much more oriented towards risk. Those that are oriented towards risk are going to be the ones that are closer to failure if things don't go right. They're expected to be there. It's kind of the normal run of things. When you're an entrepreneur and you're trying to start a business, well, the reality is that the really, really conservative bank isn't going to be interested in you. You're a brand new business. You don't have a track record. You've got a wild idea that nobody's come up with before. So you go to the bank and the bank goes, "You're a brand new business. You've never done this before. You have a wild idea that nobody's ever thought of before. Go away." But then you go down the street to a higher risk bank that says, "Yep, you're new to this and you've got a new idea. Tell you what, we'll back you anyway. Interest rates are going to be a little higher and, we're going to make our money, but we're running a risk. But without us, what are you going to do?" I used to teach entrepreneur classes, and one of the first things we talked about, very first class, was where do you get your money to start? And there was the potential to use your own resources, rack up your credit cards. That's not a good idea. You could go to an investor and say, "Hey, I would like you to back my business." But we used to point out to people that investor isn't going to do it for free. They're going to take 60%, 70%, 80% of your business. And so you get started, and then for the next 10 years, you're watching 80% of your profits going to the guy that backed you, and you're only getting 20. Ideally, you want to go to a bank. You want to go to a bank and say, "I need a loan. I want to start a business. And once I've paid you off, then you are gone. You're no longer part of my business." In order to find that bank, you've got to have some that are risk takers. And that's the tension within the banking sector. And then finally, it's not so much dual mandate, but you just don't have coordination between fiscal and monetary. The banks are still dealing with the fact that there was this flood of cash in 2020. We'll talk more about that in a minute. But our savings rate ballooned from 6% to 38%. That cash is still out there, which has made what the Fed's doing harder because there's still a lot of money in the hands, particularly the upper 30% of income earners. So we'll talk more about that in a minute. So end of banking discussion. You were thinking this was going to be about the AWFS, but you're right. Now we're going to get into that. Couple of pieces that are a lot more encouraging than the news we've seen lately. This was a survey that was done of C-levels, mostly in the US. Some of them are also from Europe, asking what they thought 2023 was going to look like. And most of them mildly optimistic about the economy, global, national, local. But what really jumps out is how confident they were in their own industry and their own company. Only about 8% were pessimistic. I mean, that's remarkable. So at the time when everybody is still talking about recession and inflation and all this stuff, when it came to their own company and their own industry, they were very upbeat. And I can reiterate that that's what I've seen when I travel and give talks to different groups. And believe me, I give talks to different groups. I mean, I just got through speaking in Pittsburgh to the AWI, which was highly normal compared to some of the groups that I speak to. In the last several months, I have spoken to the Vinegar Institute, where I learned that balsamic sales are down and white vinegar is up. I have spoken to the Pecan Shellers Association, not growers, shellers. I have spoken to the Dry Cleaners Association. I have spoken at the Clean Show. I have spoken at the Casket and Funeral Supply Association. So I get a lot of variety. And almost every one of these conferences has had the same basic message. We are doing well as companies. We have book of business, we're growing, our biggest challenges are challenges of growth. We can't find people. We're having trouble keeping on top of our costs of commodities. We're trying to keep up with demand, not generally the kind of concerns that people have when things are going south. So it's not to say that there aren't economic problems, but they are sort of showing up sectorally rather than showing up for the economy as a whole. So here's what the Fed is confronting when it comes to inflation. This is the critical discussion, because if the Fed decides to back off on interest rates, it will be because of changes in this. We see a lot of measures of inflation. One that you see all the time is the Consumer Price Index, the CPI. Don't pay much attention to that. It's a little bit artificial. It is based on a mythical basket of goods that an average family of 4 buys, assuming that there is such a thing as an average family of 4, which really there isn't now. You've got 4 different age cohorts, boomers and millennials and Gen X and Gen Z. They all spend differently. We don't know if we got the basket right to begin with. So the Fed does not pay attention to CPI. They pay attention to this. This is TMPCE, trimmed mean personal consumption expenditures. Trimmed mean just means that they lop off the highs and the lows so that it's more representative. It's a statistical thing. PCE is personal consumption expenditures. It's what people actually spent their money on. So it's accurate. The challenge is it lags. We're only going to get January's PCE numbers next week. So we'll be into April before we know what inflation was in January. We don't know what it is in February or March. We won't know that for another couple, 3 months. So the data is accurate but slow. The last data which we had from December showed a little bit of a dip. It basically indicated that inflation has probably hit peak and is now starting to come down. The question is, how fast? Is it coming down dramatically? Are we going to see January numbers that take it down below 4? Probably not. But even if it starts to trend that way, it would be an indication that enough has been done from an interest rate perspective to start to affect inflation. We are probably now not looking at 5.5% as an interest rate. Still a possibility, but the Fed has kind of backed off. Central banks in general have backed off because they're aware of the damage that has been done with higher interest rates. But the point of this whole chart is to point out that the anomaly was the last 10 years. We've had much higher rates for most of the last several decades. I mean, some of you listening, watching today, remember the 80s and remember Paul Volcker, who decided to crush inflation by raising interest rates to 20 points. You know, we're agonizing over whether interest rates are going to hit 5. And Volcker says, I'm raising them to 20 points. I'm going to kill inflation. It's going to cause a recession that's going to last for 3 years, but I don't care. I'm here to kill inflation. And he did. We're not looking at that now, thank God. If you remember, those of you who were around in the 80s, that was when, oh boy, I got a great mortgage, only 23%. It's like people would jump off bridges if it did that today. So we're kind of coming back to a bit of a norm. You know, it's been a while since we've seen rates this high. Probably we'll end up seeing them in that 3.5 to 4 range going forward. We may see them come back a little bit coming the end of the summer, but not back to where they were the last 10 years. The labor market continues to be overheated, and that's part of what has been driving some of the decision making for the Fed. There's still a lot of labor shortage. You guys know this better than most, but it also continues to keep consumer spending high. We have higher wages, and people are complaining about inflation, as they should, but they have the money to pay anyway, and they continue to. If you look at labor costs in general, they're sticky. Wages are now rising faster than inflation, rising faster than they have since the 2000s. The only way wages come down is when you lay people off, because it's not like you can give somebody a wage increase and then say, "Oh, sorry, things got better, I'm cutting your wages." You've lost that employee. So unless you start laying people off, the wage increases just keep escalating. And as you can see, when you do lay people off, 2008, wages drop like a stone, and then it slowly comes back up again. The Fed target is 4.5. We're still a long ways from it, and that's going to continue to be an issue. We have unemployment rates that are now harder to compute than they used to be. Part of this is because we work differently than we used to. The gig economy is a real thing, and it has been for a number of years now. We're familiar with it through Lyft and Uber and all that kind of stuff, but it's a lot more complicated than it used to be. I mentioned that I spoke to the Dry Cleaners Association. I've brought this up before, but it's a good indication of how diverse this gig economy has become. Their big concern has been internet laundry. People look at me and say, what the heck is internet laundry? Well, in the period when 2 to 5 million women were sent home to take care of their kids because the schools were closed, they still had to make money. And they decided that one of the ways they could do that was to do other people's laundry. And the average take home was $350 a day. So now these women can get back into the workforce if they want to, and take that minimum wage $15 an hour job, make $120 a day, and pay taxes. Or they can keep making $350 a day doing other people's laundry, and the only people that know they're doing it is them and the person whose laundry they're doing. Their number one client, target, customer was the millennial male, and still is. So you have an awful lot of people who are not getting into the workforce because they don't have to. And if you ask them, do you have a job? No. But they do, sort of. They're making money. People who are doing gig jobs like Uber and Lyft, when they're asked in the household survey, which is one of the ways we measure unemployment, if we ask them if they have a job, many of them say no. I don't have a job. What do you mean you don't have a job? You've been driving that Uber Lyft thing for years. You've got, according to your profile, 78,000 trips. I mean, what do you mean you don't have a job? It's not a real job. Don't have a boss. Don't have to answer to anybody. If I don't want to drive, I don't drive. If I want to take a week off, a day off, an hour off, it's my call. Don't have a job. Yes, you do. No, I don't. Yes, you do. We don't know what to do with them. We don't know how to even categorize them. Are they working? Obviously. Are they working formally? Maybe not. And that's made it difficult to figure out what the actual unemployment is. And that's part of the reason you've got some of the labor shortage. The other big labor shortage issue is retirement. By the end of this decade, 2030, all of the baby boomers, every last one of them, will have reached retirement age. All 76 million of them. We have a population of 330 actually million people. 76 million is a big chunk. Many of them, boomers, are still working. We are notorious for not having lives, and we just keep on working. And you can do that in your 60s and 70s. Gets a little harder in your 80s and 90s. So little by little, this cohort is leaving. And those are not necessarily easy people to replace. We'll talk about that later too. So the good news is that when Americans get depressed about the economy, they spend. So we're seeing a lot more spending than we would think we would see, because there's still a lot of money in the economy, which we'll get to in a minute. And what people tend to do is engage in retail therapy. We definitely have seen credit tightening, but this can be a little bit of a win-lose situation. The credit is tightening, standards are tightening, certainly after the last couple of weeks. However, banks are now, again, they're in the risk business. They have to loan, they have to, or they don't make any money. Now they're looking for the kind of loan that has collateral attached. They're a lot more excited about manufacturers now than they used to be. If somebody comes to them and says, hey, I've got a great idea for a coffee shop and I'm going to open right next door to a Starbucks, the bank is going to be literally heaving them out the front door saying, I am not loaning to you. That's stupid. A manufacturer comes to them and says, I want to buy a $1.5 million machine. The bank is like, oh, really? 1.5 million, you say? That's great, because if something goes wrong, I now have something of value that I can get rid of, sell. It's collateral. So you're seeing a lot more interest in manufacturers, even more in some construction, because the bank sees the potential to do something if all goes south, and they end up having to do something with that loan. Where do we think we will be growth-wise in the coming year? GDP now is basically an ongoing kind of daily updated study that comes from the Atlanta Fed. Their most recent estimate for the first quarter of this year is 2.6% growth. And as you can see, it's coming back up. It was dropping down to around 2% growth. Now it's coming back up to 2.6. Earlier in February, they had it even closer to 3. So the GDP now numbers are continuing to go up, and they're sort of indicating that you're starting to see some fairly impressive growth numbers in areas that make sense as far as getting the economy off dead center. We're seeing a lot of growth, for example, in aerospace. We're seeing it in automotive. We're seeing it on agricultural sector, manufacturing. Even in construction, which we'll talk about in a minute. Definitely not good news on the single family front, but the multifamily housing sector is growing like crazy. So here's what we're seeing with residential construction. Not good numbers. I mean, these are coming down pretty dramatically from what they were last year. Monthly supply of new homes is way down. So the kind of debacle that we were anticipating as far as residential is here. Single family permits way down, mortgage rates are higher, prices are still high. But if you separate out the multifamily permits are up 12%. Multifamily is growing at a record pace. We haven't seen these many permits issued since the 80s. There is still a 5 million house short in the US. There's still a demand for housing, but people are having trouble getting into the single family, so they're turning multifamily. Eventually, that begins to affect single family because we've seen the pattern over and over and over again. Multifamily demand then increases rents. At some point, the renter be at the market and say, wow, my rents are high. Existing home prices are coming down. Mortgage rates are beginning to sag just a little. They're down from what their peak was even a few months ago. And you begin to see people say, well, why don't I buy an existing home and get out of the rent mess that I'm in, et cetera. But for the time being, this multifamily growth is awfully good for people that are in the manufacturing sector, more appliances, more textiles, more of what goes into a multifamily unit. Some of the forecasts going ahead are a little bit all over the place, but we're looking at housing starts kind of rebounding as far as the next couple of years is concerned. A lot of multifamily activity, interest rates probably showing some decline. Fixed rate mortgages going from 7% down to 6%. Obviously not as good as it was in 21, but heading in a more acceptable direction. If you look at some of the projections going ahead for GDP 2024, like I said, the Atlanta Fed thinks we're going to be hitting 2.6. But then after that, everybody is saying, yep, probably, 2.7, 2.2 going into 24. The depressing assessment of 23 is kind of based on some suppositions about what interest rates do and what employment does. And there's a lot of variation according to the forecast. So you don't have a lot of consensus around going into the negative numbers in quarter 2, 3, and 4. I've seen some that are pushing that way up close to 3% growth. So there's a little something out there for anybody. If you're a glass half full person, you'll find justification. If you are a glass half empty person, you'll find justification. Kind of pick your poison. So non-residential is showing a real growth trend. I mean, we're above that 20-year dotted trend line by quite a bit, and we continue to grow. We've seen a bit of a dip in this last several months, but then it reverses and keeps going back up again. It's been driven by warehouse and logistics, but now office buildings are coming back. There was an assumption made, which turns out not to be accurate, that we would never go back to work in a traditional environment, that we were all going to work virtually forever. We would never buy pants again. We would never have to be in the physical presence of anybody. That's turning out not to be true. Turns out that supervisors hate supervising people who are working at home. It turns out that it is really hard to onboard new employees. It turns out that there are a lot of sectors that never could go virtual. Manufacturers, they take a dim view of the guy that says, I want to work at home, so I'm going to take the laser cutter and put it in my garage. No, you're not. So even sectors like accounting that felt like we're ideally suited to be a remote business, they're coming back to the office. Different environment. Now it's more of the 3-2-2 model or the 2-3-2 model, 2 or 3 days in the office, 2 days working from home. But office buildings are making a comeback. Retail space is making a comeback. Everybody was concerned that from here on out, everyone would be nothing but online. Say, well, it turns out that there are all kinds of reasons that people buy things. And top of the list, beyond the fact that you need whatever it is you want, whatever it is you bought, shopping is entertainment. It's retail therapy. There is not a lot of thrill going online and buying something. It's more fun to go to the store and see what's there. So our habits haven't changed as much as we anticipated they were, and it's having an impact on non-residential construction. The bad news is that producer prices are higher by quite a bit. They're starting to come down just a little, but they're way above that trend line. And that's something that's going to be with us for a while. Lumber prices have come down just slightly, but steel prices are still all over the place. Copper is expected to go up dramatically. So the material price index is still something that's of concern because it's still going to be putting inflationary pressure on many businesses. If you look at sort of the overall corporate investment pattern, it's still very strong. We have seen more corporate investment in the last 4 or 5 years than we've seen probably in the last 20. This is just computer and electronics, but it's kind of illustrative of what you're seeing in a lot of the sectors. What's driving this is the worker shortage. Companies are unsuccessful finding people, so they're putting more and more emphasis on robotics, technology, automation, certainly seeing it in the industry that you represent. People have no choice. I mean, they can't find individuals, so it's like, well, I may not have done the capital intensive thing before, but I don't have a lot of choice now. I'm going to have to find ways to replace workers, and it's getting into the service sector more than it used to. It was always seen as kind of a manufacturing centered response, that it was the manufacturer, construction to a degree, that was going to use robotics. But I've talked about this before too, but I went to a conference in St. Louis, and in the conference hotel, go downstairs, order my breakfast, get a little device that I think is my pager that I'm supposed to come pick up my food. Oh no, it's connected to a robot. So as I'm sitting at my table, this little robot rolls up wearing an apron that says Marge. And Marge cheerfully says to me, "Good morning. Here is your breakfast. You ordered eggs Benedict, a glass of orange juice, and a cup of coffee. Would you please sample your coffee to see if it's the right temperature?" So I do. "If you're satisfied, please hit my green button." So I do, and Marge spins around and leaves. Best service I've gotten in months. The little robot cared if my coffee was hot. Yay! So I talked to the guy that runs the place, and I said, "This cannot be cheap. What prompted you to bring in a robot server?" And he said, "Look, the people that I have to hire now, I just got tired of it. If they showed up at all, they showed up drunk or stoned or in a bad attitude. I got 2 kinds of customers here. I've either got business people here for the conferences, or I have my elderly that's there to play in the casino. Neither one of you want to deal with these surly servers." So I'm done. I said, the elderly love Marge. They'll talk to her for 20 minutes. Doesn't say much, but she's a good listener. He says, I'm done. I'm automating. And this has been a boon for me. He says, it's just been great. And you see more and more and more of this in the service sector, which is pushing more and more of the orientation towards computers, towards robotics, et cetera. And it's showing up in a lot of the data. The biggest concern really going forward, I mean, not that inflation isn't a concern, not that the job market, et cetera, those are all legitimate things to worry about. But one of the things we collectively, in response to the supply chain fiasco, was stock up. Inventory levels are very, very high. We now have 70% of the marketplace declaring that they're overstocked. Only 13% declaring they were understocked. So what you've got is an awful lot of entities with a whole lot more inventory than they need. And this is creating concerns because get rid of that inventory, they're not going to be in a position to do any reordering. You know, you look at the bottom of this list, you know, who's got the most concern? I mean, these big glowing red numbers: household appliances, general merchandise, furniture wholesalers, building materials. You know, they're all in a position of having more than they need, and they don't know quite how they're going to get rid of it. Global highlights, not going to spend a lot of time on this, but the Purchasing Managers Index has always been a good way of tracking what's happening in the manufacturing sector. Purchasing managers don't know enough to lie. So if you ask them a question, you get a straight answer. And the question you ask is very simple. Are you buying more or less of anything? So you turn to a purchasing manager and say, are you buying more or less lumber? More. How come? I don't know. I don't even know what we make, man. Somebody said buy more lumber and we're out of toilet paper. I'm the purchasing manager. I don't know why I buy anything. Somebody tells me to buy it, I go out and try to find a good price. I'm not going to question my CFO and say, sir, why are we buying more of this? What he's going to do is turn to me and say, Binkley, shut up and do your job. Just buy what I told you to buy. So it's 100% accurate data. They're either buying more, buying less, or buying the same. It's also easy to understand the diffusion index that says anything over 50 is growth, anything under 50 is contraction. We had 12 countries that were in contraction in February, 19 in January. The US is still in the 40s, but a lot of other countries, India, for example, has been in the 50s and has stayed in the 50s throughout the last couple of years. It's one of the fastest growing economies in the country. Mexico is back in the firmament of above 50. So this may be the critical slide. Saved it for later in the presentation for those who are still awake. There is an incredible amount of money in the economy, and we don't know where it's going. This chart goes back to the 50s. We have never seen this much money in the economy, $3.5 trillion. This is left over from the 2020 stimulus and all the other things we went through in that period because we were trying to stimulate the economy, somehow forgetting that if you give consumers money, you also need to give them a place to spend it. So if everything is closed, they're not going to do much with that extra cash. So now it's sitting there. Our savings rate went up dramatically, 6% to 38%. Where is it going to go? Is it going to go into services? Is it going to go into things? Is it going to go into investment? One of the reasons the Fed is struggling to keep control of inflation is that the shadow banking system is so huge. And as sinister as that sounds, it isn't. Shadow banks are simply non-bank institutions that can lend money. That includes insurance companies. It includes venture funds, angel funds. All of that extra money found its way into a lot of those funds. And so the Fed's trying to dry up money supply, but you've got a venture fund sitting there with record amounts of money mandated to spend it. If you put your money in a venture fund, they're not about to come back to you and say, hey, thanks for all the money you gave us. We're not going to do a blessed thing with it. We're just going to sit on it. And you're like, oh, no, you're not. You're mandated to spend it. I put my money with you to make more money. So the venture funds are still pushing money into the economy, even as the Fed is trying to slow it coming in from other sources. Reshoring, as I mentioned before, it's a real thing. We've spent about $1 trillion on it already last year, probably going to see around 6 to 10 trillion over the next 10 years, being driven by everything from national security to just the convenience of having more production in the United States. That brings its own set of issues. If we are short workers already and we keep bringing more business back to the United States, where are we going to find the workforce? That drives more robotics activity. And we're not seeing US companies come back alone. A lot of foreign companies are coming here as well. We had all the conversation about the chip shortage a year ago, still kind of an issue, but now beginning to subside. Got the development of Intel's new facility in Ohio, but Taiwan Semiconductor, which is the company that we are most dependent on for chips, they were going to build one in Taiwan. They changed their mind and they're building it outside Phoenix. Samsung is building one outside Dallas. So foreign companies are also bringing production to the United States, not even back to the United States. They're just coming here for the first time. Nearshoring too. A lot of foreign direct investment in Mexico, up almost 30% in the first 9 months of last year. Largest volume in history for Mexico. 45% of it brand new investment. Most of it in the northern part of the country. So the sector that's getting the majority of the FDI, surprise, manufacturing. So you're seeing a lot of this development of this kind of North American construct, which was the whole idea behind NAFTA 10 whatever years ago, and now is kind of being driven by the supply chain issues, concerns about what we do with China down the road. We're still seeing a lot of progress on the fuel front. That has a lot of implications for business. We are the world's biggest oil producer now. We are the world's biggest oil exporter now. We're going to be hitting records this coming year between 13 and 14 million barrels a day. Our consumption is around 20 million barrels per day, but it's only down because we don't commute as much as we used to. That commuting is coming back. We used to consume around 24 million barrels a day. The difference between our production and consumption, we generally make up from Canada and Mexico. So we are now very close to balance when it comes to production and consumption globally, not just in the US. Crude forecast prices in the 70s this year, going into the low 70s by next year. Diesel down over $1 and continuing to fall. Gasoline down nearly $1 and continuing to fall. So the oil, gas, energy discussion is less urgent than it has been in previous years. It has all kinds of implications for the alternative energy market. We could go on for days about that, but interest in things like electric cars and alternatives is always connected to the price of fossil fuel. So if gas prices, diesel prices, oil prices are down, enthusiasm for alternatives also comes down. Transportation has begun to work itself out somewhat. At the beginning of last year, we had a serious capacity issue, and there were 14 loads for every truck. I'm sure all of you encountered the challenge of trying to get trucks and drivers. By the end of the year, we had reversed most of that capacity shortage because last year alone, we saw 65,000 new trucking companies come into existence in the US. There is no easier industry to get into than trucking. If all of you end this webinar by saying, I'm tired of being in my industry, I'm going to become a trucker. What do I need? A truck and a CDL. So if you get a commercial driver's license and a truck, you are now a trucker. And 65,000 new companies came into existence, and that's why you're suddenly seeing things like Mama You Betcha's Real Good Trucking going down the road. How long you been in this business there, buddy? About a week. Many of those companies are starting to come out now because the money that was there to be made has been made, and now the capacity issue is not as dire. We went from 14 loads per truck to 4 loads per truck. Ideally, it's down to 2. So we still have a little bit of a capacity issue, but you can see what's happened with pricing. Rail is down, trucking is down, even maritime has come down. The container shortage has been alleviated temporarily. That may be something that begins to change in the next couple of months as China continues to gear up. So the conclusion of all this, kind of winding it up, is that we're kind of going back to where we were. We had this dramatic decline in 2020. We have the dramatic recovery in 21, 22. Now we're going back to what looks really familiar. It looks like what it looked like 2012 and 2015 and 2016 and 2018. Very similar growth, somewhere in that 2.5, 2% range. Not great, not right home like, wow, we're growing, but it was acceptable for a good 10 years. Probably seeing more of a decline with some of the emerging markets, the EMDEs, the advanced economies, more traditional growth patterns. So here are my last 2 slides. First slide is my fearless forecasts. Inflation is going to remain an issue, still probably around 4% by the year end. Unemployment rate still low, starting to creep up a little bit, but kind of hard to track, as I talked about before. Many of the labor issues are endemic. They've been building for a very long time. Most of the layoffs we're seeing have been in high-tech areas, or, for example, the Amazon phenomenon, and recognize that some of these companies were rich beyond the dreams of avarice. I mean, Amazon was able to do things that other companies can't do. Rather than sitting around and figuring out where to put a warehouse because, well, got to conserve money, they just built them. And it's like, okay, whichever 10 of them makes sense, we'll keep, we'll close the other 10. Don't you think you ought to figure out which 10 you no, that takes too much time. Just build 20 and 10 of them will keep and the other 10 we'll get rid of, and then we'll build 30 over here and keep 15. They had the money to do that, and they did, so when they shut down a facility, it's like, oh yeah, we were going to shut it down eventually. We were just waiting to see which one made the most sense. So that kind of behavior is going to be a little bit rarer. Chances of a recession still not particularly good, a little bit reduced. We're certainly going to see a slowdown, but it's going to be more sector driven more than it is an overall slowdown. Retail has seen a reduction, kind of coming back. We'll see what happens in summer. Hospitality way down, but coming back. You're starting to see a lot more activity in the airlines. I can attest to that. It's like I don't think I've seen an empty middle seat in months. So we're definitely seeing a recovery in that area. Little bit of life coming back to agriculture, and that's something that is going to be watched pretty carefully too. But that shows you how quickly things change. A few months ago, the only conversation about the West was the drought, where farmers aren't going to plant anything. It's a drought. Now you have farmers in California who are planning to plant 10 to 15 times more than they had originally planned because the soil moisture is so high. The reservoirs are filling up. When you start getting the snow melt in the spring, it's going to be refilling lakes that were on death's door a year ago, and it's suddenly changed for an entire sector. Consumer demand continues to be strong, even with inflation. It's predominantly the people who are in the bottom 70% are the ones who've been hit hard by inflation. They're using credit cards to pay for necessities, but the 30% is still spending aggressively. Housing will still stay split. Growth, multifamily, single family still struggling. Commercial construction strong this year, but worried about 24. The pipeline is shrinking. They don't see as many big projects on the horizon as they have the last couple of years. And then this slide is the one that explains why the last slide may not be correct. This is my cover myself slide. There could be a worse bank crisis. We don't think so. It looks like this has been a 2 or 3 week phenomenon that we're going to get through. Depositors have calmed down, investors have calmed down, but you never know. You know, another big bank that gets in trouble could start it all up again. We could have another black swan. We don't know. China and Taiwan, North Korea, Russia, any one of those could be involved in something that strikes the entire planet as desperate and threatening. We don't think that's going to happen, but you never know. Major political upheaval in Latin America. Almost the entire Latin American continent now is led by left-wing regimes, all of whom are struggling. We don't know what that will turn into. We already know that it's affected things like the copper market. There could be a surge in energy prices, not likely, but when they happen, it shocks consumers and they tend to go into retreat. But we always have to be cognizant of weather, geopolitical issues, the energy sector changes. Central banks could get more aggressive. They're not at this point talking that way, but if they get more and more worried about inflation, they could keep hiking rates, and they could hike them even higher than we've expected them to go. Big layoffs could start. Doesn't seem likely in a worker shortage environment, but when they start, if they start, consumers get very worried. They're concerned that their job may be next. Politics will not play much of a role this year, but that will next. This is the point in the campaigns where both parties play to the base. They're basically looking at the 10-15% of the true believers that are engaged. The 70% of us that are not true believers, we don't count until next year. And then all of a sudden, the focus shifts to economics. It's the economy, stupid, but that doesn't come up until the elections get close, because most of us are still looking at all the candidates going, seriously, this is the best we can do? We have 330 million people, and this is it? I mean, really? So we finally decide to vote, if we do, next year. Last year and the year before and the year before that, the polls suggested that something like 70% of voters went to the polls to vote against somebody, not for somebody. It's like they didn't really like either one of them. They just picked the one they liked least. So what a mandate for democracy as a whole. So with that, last slide. This is the chart that explains it all, everything you'd ever wanted to know in one chart. And with that, I'm throwing it over to Adria, and she will tell you what to do next.
Thank you so much, Dr. Kuehl. Super informative, lots of information as always. So let me get the little slideshow going again. So before we leave you, I just want to make sure that you're registered, you're subscribed to the Flagship report. It was briefly visible on Dr. Kuehl's last slide, but this is a great publication that they put out 3 times a week. And AWFS shares the Monday issue. So if you are a subscriber, then you got it yesterday, but they also put it out Wednesdays and Fridays. So if you like it, then you can order the additional ones with him. But please take advantage. If you're an AWFS member company, sign up for the Monday one through us. And I'm also very happy to, if there's any questions, please post them in the chat while I'm talking here. The next webinar with Dr. Kuehl will be Wednesday, June 28th. So you can go to awfs.org/webinars to see the registration information, and the recording will also be available on that page. Please complete this survey. It's very helpful to us so that we can know how if this survey met your needs, or excuse me, this webinar met your needs, and how we can improve for next time. And I'm super excited to share that Dr. Kuehl will be with us at the AWFS Fair again this year. He was there in 2021. He's coming back. He's going to be on our show floor stage. So if you're not yet registered, please go register for the fair today, awfsfair.org. Registration is really affordable right now, so do it before the price goes up, and then you'll get all the information about where and when to see Dr. Kuehl present live.
The
So,
best thing about the AWFS fair, the last time I attended, was I came away with what has to be the most unique bow tie ever made. It was a wooden bow tie, which I still have. I don't wear bow ties as a rule, so I'm still looking for an opportunity to sport this, but I'm very proud of my wooden bow tie. So
oh, that's wonderful. And you're welcome to wear it to our show. I'm sure people enjoy it.
thanks.
I know some people who are the whole groom side of a wedding party is going to be wearing it in a couple months.
There you go.
So they've made their mark. So still not seeing any questions. You know how to reach Dr. Kuehl or myself if you have any. I'm happy to pass them on to him. Thank you for joining us today. And I hope you have a wonderful rest of your day. Thank you.
Thanks.